Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today on the EIA show, we're going to go through and break it up the way we normally do. Just an overview of the U.S. data, then a deep dive on the refined products, and then going abroad and looking at what's happening in Asia, Europe, and how the U.S. integrates within all of that. So one of the things that we've been trying to do is, in case you only have 30 seconds to watch, we try to provide some brief overview of the data and just holistically look at it. So we did get a crude build, which was something that we've been expecting when you look at what's happened with exports coming down, imports coming up. And based on last week, we were saying, look, exports were going to continue to weaken, but imports were going to flatline before they continue to start rising. And we thought it was going to come up a little bit. It ended up dropping a small amount by about 75,000. We'll go through that in a minute. But when you look at the general backdrop, we're seeing a lot of this flatlining. And this is what we've been talking about. And when we look at gasoline, one of the things that we were saying is that we were expecting to be at about 9.6 million barrels a day in demand, ended up coming in just based on how the EIA calculates it was about 9.78. But then when you look at Gas Buddy, when you look at Descartes was at about 9.5. Gas Buddy was at about 9.6, 9.7. So you're starting to see, and now we're seeing that we're going to get this bigger drop, and we're expecting to actually come in closer to about 9.1 as we go into next week. So you get an idea of this lumpiness, and then on the distillate side, it's going to have the reverse. We had a big drop. We expect to see a big increase. All the while, things continue to slow in Asia. And with the ramp up of COVID in China, you're starting to see lockdowns come back through, people being told to stay home. And that's actually going to put more product on the water, even though they've been trying to walk back some of that export capacity. They're now going to put it back into the water, with India now also signaling more product to come into Europe. So that's where we had a nice slowdown on imports for gasoline, drew more from storage, but now we're going to have more product coming into the Atlantic Basin. That's going to start to provide some bridge, but we expect to see gasoline draws continue. We expect to see demand moderate a bit. And then we do expect to see crude continue to build, but at a moderate pace versus where I think a lot of the, individuals who are a bit more bullish expected to be. And again, as we've shown from Anas, actually has a great slide looking at kind of where the bulls were expecting and where we are right now. And you see that we've actually deviated from their trend or from the bullish trend a while back. It's just a matter of when does that narrative catch up, because the goalpost keeps moving in terms of when is demand going to catch up. And as we've been saying, is like, look, we saw the pent up demand. It happened. We now have seasonal demand, and as we go into the fall, we're going to have our typical seasonal slowdowns because people are back at school. School is going to pick back up. You're going to have more school children at school in person. That's going to free up some people to do a bit more. But again, work from home is a bit stickier when you look at flex schedules, which is going to moderate, from a little bit from normal what we expect to see for gasoline. But we'll go through all of that in more detail. So inherently, summarize it, this was a fairly bearish report. There were some bullish pieces, which we'll go through, especially in segment 2. But overall, when we take this and then extrapolate forward, we're going to continue to see some of this data coming out on the bearish side. So now when we look at just overall crude oil inventories, you can see here that we're right in line with 2019. And this is kind of that sideways move. And the one thing that we always want to look at is when you look at seasonality, because when you look at what normally happens right now, you can see when we look into 2018, when you look at 2019, when you look at 2016, you do have periods of builds. And that's why when we look at what are we going to get overall, we're still going to get draws. It's just the draws are going to be a bit, are going to be moderate versus I think what some individuals in the market are expecting when we still have capacity. When you look at exports, we still have really slow demand coming out of Asia. And then obviously the same in terms of coming out of Europe in general. So then when we look at days of supply, we flatlined, we're right at about 27.2. You can see that there's only been 3 points times when it's been higher, which is obviously 2020. And then when you look at 2016 and 2017. So this is looking at crude and storage and refinery throughput and figuring out how many days do we have in coverage when we look at just commercial, not looking at SPR, but commercial. And you get an idea of just how we still remain well supplied with oil. And you can also see that there's a typical downtrend. Like I've been saying, we always draw from storage. So the question is, what is the rate of reduction? And then what do we expect as we go into shoulder season? And that's where you can see things moderating and again, kind of pivoting away from some of that more bullish sentiment. So then when we look at product and storage, you can see again, just continuing to see a very steady trend, nothing really accelerating, just moving within the 2019 realm. We expect to see this adjust a little bit in terms of flattening out just a touch more with a slower drawdown and then a little bit of a reversal in gasoline. Again, we're going to still see draws in gasoline, but just not at the 5 million level. We're going to have something a bit less. And we do expect to see some distillate picking back up when we look at storage in general. So when we look at gasoline storage here, you can see that we're right back to the lows that we had in the beginning of February, the middle of May. So we're coming right back into that low point. But when you look at, again, looking at what period we're in right now, we typically have this downtrend into Labor Day. So we're not seeing anything crazy in terms of cycles, but the one piece of it right now is the pace really picked up this past week, which is why we expect to see another draw. It's just going to be at a bit more of a moderate pace as it continues to follow the top end of that range through the end of summer. So then when we look at distillate had a small build. So you can see you had a little bit of a reversal. Again, the trend still remains up, but at a more moderate pace. So we do expect to see distillate builds accelerate. And that's going to be a mixture of the way which crudes are run, as we've been talking about, with more imports, less exports. So more imports will yield a bit more distillate. And you're also going to see this marriage between how are they managing their kerosene or jet fuel, because jet fuel has had a fairly large build. So you can put some of that jet or kerosene into the disti cut, and you're going to start to see that get managed as well, which again still puts us back below in something a bit more normal. But you can get an idea that as we go forward, and we'll talk about this, we're going to start to see some of that flying moderate as we come into the end of summer. So then when we look at the curve is telling you, not too much has changed when you look at the going out through at 65, still well into essentially the beginning of 2022, still above 65 until you get into 2023, still above 60. So you still have a fairly strong move. You've had some moderating in the front months. But then when you look further down the curve, you can see that there's been a bit more pressure on the longer end. And that's really that uncertainty when we look at OPEC and what does that mean? Because there's always been commentary that there's been no investment. But as we keep talking about, NOCs don't have to report anything. And that's where when we look at what has been invested in and when you look at some of the investments in general, a lot of it has been in the Middle East. You had some in Latin America, and that's providing some of this uplift when you look further out, especially when we're considering where some of that new supply is going to come from. So when we shift to changes in COVID, you can see that worldwide, we're still at a fairly elevated level, with the U.S. starting to climb back up. Again, case count versus hospitalizations is always going to be key. Case count can go up, but if people are avoiding hospitals and able to not have to go back in terms of stressing the supply chain, that's a positive. My mother, who works at one of the biggest hospitals on Long Island, she's saying, look, it's going up, but not as many people in the ICU, just people coming in, needing some support. Again, not like we saw back in February, March, and in April of 2020. You're just not getting the same type of movement and it's just because, again, viruses naturally mutate to be more contagious, less deadly. and you do have the vaccine. So again, these are things to look for when people are starting to panic a bit. Just look at what is happening on the hospitalization side, and so far things have been very manageable. The UK has started to come back down, but the problem is it's flattened out again. And then the same can be said when you look at India, when you shift to Asia Pacific, South Korea, Japan, Vietnam, Malaysia, Thailand, all showing some very elevated levels. And then the other one, which is not on this chart, but Indonesia is another one that continues to see a big increase. And they happen to be one of the biggest importers of gasoline and other products. So again, that's also going to cause some additional slowdown when you look at Asian demand, and Europe is starting to flatline a bit along seasonal norms and pulling back. And it's a mixture of just a little bit of a COVID increase, some of these adjustments. Then there's the communication is always fantastic when you look at CDC, because now they're saying, like the WHO is saying, don't use a third Pfizer booster, let other countries get the full vaccination. So again, the miscommunication and just backstop is always fascinating. So now when we break down the numbers a bit, here's where we had the crude build, 3.63 million barrels, still 40.6 million below the 5-year average. But again, as we've shown in those the previous charts, how skewed that really is. But then when we look at where the builds were, you could see it in Pad 3, which is where we keep talking about expecting to see these builds. Pad 3 is only 2.7 million below the 5-year. Yeah, it was a build of 3.1 million. Then when we look at Pad 5 is the one that's going to remain lumpy, especially when we look at imports, just because of the issues that they have at the coast, but they continue to import crude as well. So here we had Pad 5 with a build of 1.4 million. Now, the one that's going to be interesting is Cushing, because Cushing had another draw of 540,000. Now we're below the 15-year average when you look at Cushing, and you're starting to get to a point where, I would have expected we would have started to see some builds, and again, not like 2 million, 3 million, but something along the lines of 250, 500,000 barrels, slowly starting to see this moderation, but we haven't seen that yet. And we expect to see a little bit of that and just kind of maintaining some of this level. Then when we look at crude production, we have some work going on in the Gulf of Mexico that has dropped things off. So they're estimating 11.2. Again, we're still sitting there at that 11.45. And especially when we look at shale, we have an article coming out in the American Oil and Gas Resource, AOGR, and that's where we have a little bit of an update on what we're thinking in that realm. So then when we look at land storage, so stockpiles fell last week by 9 million to 610.5 million. In total, when you look at the numbers, you can kind of see that we're just starting to see that flat line. Like the previous time, we were up 6.8. Then the week before that, we were down 8.2. So you can see that we're still getting draws. They just happen to be a bit more on the moderate side and really moving along that 5-year average, especially when we look at the 5-year on the total land storage, looking at U.S., ARA, Japan, Chinese stocks. And China's actually starting to reverse, and we're starting to see some builds. And that's something that we're going to talk about, especially as COVID continues to ramp up within the country. West of Suez, you had the U.S. draw, but you had the Europe build, which is why we went sideways. And then here, when we look at east of Suez, you can see that we still remain fairly close to the 5-year average, to the top of the 5-year range. So again, there's still a lot of crude in the market, and just based on the pace of drawdown, you're really starting to see that slow. And then when we look at floating storage, you can see just how much it's slowing. When you look at total storage, it's still at above the 5-year average, the 5-year range. Then when you look at west of Suez versus east of Suez, it's east of Suez that remains elevated, with Asia and the Middle East continuing to see an increase. And then we expect to see more increases in West Africa, as the U.S. Gulf of Mexico and Europe still remain at very low levels. Now, when we look at the demand recovery in the different regions for mobility, China continues to come lower. So this is going to be updated, and you're going to see them come closer to that 80%. Europe has flatlined. We expect Europe to now not really just go flat, but start to increase back up as you get that last push for August. Then when you look at rest of Asia, continuing to remain depressed, that's going to continue. And then when we look at the Americas still remain weak, not because of the U.S., but because of Latin America, where we continue to see some of these problems. Now, just putting the Chinese issues on travel in context, local travel restrictions are emerging. The transport minister banned ride-hailing services from crossing city borders in medium and high-risk regions. Jiangsu province closed 83 highways. Train stations in 23 cities have been ordered to suspend passenger service to Beijing. And then before, when we look at China, had 4 areas designated as high-risk regions and over 140 of medium risk. So to give you an idea of that ban on ride-hailing between borders of medium and high, you're looking at about 150 or so areas that have reached that levels. So more travel restrictions are actually in the works. So it's only going to get worse. So that's going to be something to watch when we're looking at mobility and how much product that's going to put on the water, because we know it put a lot on previously. So when we look at just a brief look at Europe, this is looking at toll roads versus 2019. So you can see that when you go back to July of 2020, this is where we kind of peaked and then started to come off. And we're starting to get something very similar where we're starting to peak and now we're starting to roll over a bit. We don't expect this drop down. That drop down was obviously with new lockdowns, but instead we expect it to be just below that 2019 level or normalcy, if you will. So then when we look at crude oil storage in PADD 3, you can see that we've started to about face and moving closer to 2017 levels. And that's what we've been saying, where we're just going to go sideways, especially in PADD 3, because you have exports that remain under pressure, especially when you consider, against Dubai, against Brent, against West Africa. It's going to be difficult to get this additional crude coming into the market, especially when the demand is more on the distillate side and less on the gasoline side. So again, that's going to put the U.S. blend at a bit more of a disadvantage, which means it's going to have to price at a steeper discount in order to incentivize movement. But again, I can go through the intricacies, because U.S. crude can create diesel, but if it creates diesel, it creates really terrible gasoline. If the focus is shifted to gasoline, it makes strong gasoline with decent octane, but no diesel. So it all depends on how you run it, how you blend it. But just looking at the discounts abroad, especially in the Middle East and West Africa, and what we're seeing coming out of Latin America, you would opt for those blends before you opted for U.S. crudes, especially at this price. So that's why we expect to see this not so much continue to build, but again, just go sideways and just remain elevated. And then you can see just in terms of where we are, there's only been 3 years higher than we currently sit. So when we look at Cushing, this is what we were talking about, where you're seeing it fall back below the levels on the 15th. On the 15-year average, this is where we expect it to at least flatline, just because you're starting to, when you start talking about working capacity, we're getting closer to those levels. So then when we look at imports, here you can see imports were down 76,000 barrels a day, just from 6.5 to 6.4. We expect that to creep back higher, closer to about 6.7, 6.8. Still almost 1.1 million below the 5-year average. The drop was driven by PADD 1, PADD 2, and PADD 3. PADD 3 only had a drop of 98,000 barrels, but PADD 2 had a drop of 251,000 barrels a day. That's going to reverse. We're going to see, again, PADD 2 see some increases, PADD 3 continuing to stay fairly flat, but waffling back and forth. We expect to see a little bit of a bump in PADD 3, but PADD 5 had an increase of 364,000 barrels a day. That will reverse down, but still remain elevated, because when you look at the 5-year average, it's 338,000 above the 5-year average. So even if you get a drop, week over week, you're still going to be elevated into the 5-year, against the 5-year. So we expect to see that remain elevated. And when you look at just some of the movements, when you look at gasoline imports from Europe, those are continuing to move a bit lower. But we do have a fairly steady flow of product coming in from Asia, which is going to keep imports not only of just oil, but also product flowing into PADD 5. So then when we look at runs were up a small amount by 0.2%, went from 91.1% utilization rate to 91.3%. Being at this level, this essentially takes out the ability to hit 93%. Realistically, we could get closer to maybe 92% over the next week or two, but we're starting to crest past where, typically as we go into mid-August, is when you start to see turnarounds increase. You have maintenance coming through. So that's where we're just not gonna get to that level. So again, that's just less oil that's gonna be demanded, leaving that in the market as refiners try to manage their storage heading into the shoulder season. So then when you look at where that was created, PADD 2 had a drop of 117,000 barrels a day of throughput. PADD 3 had an increase of 191,000 barrels a day. As we go forward, you're going to get some gyration within that, but we think it's going to be fairly stable at these levels. Then when you look at implied demand, as we said last week, we expected to see a bit of a bump. We were thinking on the gasoline side, 9.5, 9.6. Instead, we came in at 9.775 million barrels a day, which was an overshot when you compare it to what Descartes was saying, what Gas Buddy was saying, what we were saying. So again, it's always a matter of these movements. And then, as we were saying last week, we expected distillate to see a big drop, but not by 738,000 barrels a day. We thought we were going to go from 4.35 to about 4. Instead, we went from 4.35 to 3.61. So again, you had too much of an increase on one, too much of a decrease on the other. That'll start to match up. But again, this will all leave us very much away from the seasonal norm as we go into the remainder of the summer. Then when we look at jet was fairly flat. We think that'll pare back a little bit, but still remain fairly elevated. And then propane saw a nice bounce off the bottom of 334,000 barrels a day, which again still is going to be lumpy, but that'll still remain strong. And then Asian refiners are again continuing to struggle with COVID-19 in the region, which is just keeping this elevated, is going to put more cargoes of middle distillate into Europe as the arbitrage window continues to widen, as we've been talking about. We expect to, where the first wave is already hit, we expect to see more behind that. And then 30 private Chinese oil processors in Shandong were required this week to agree with local authorities on following regulations that's prohibiting on the resale of crude imports. Again, these are going to be bigger issues overall. So you're going to have these crudes show up that they're not going to be able to resell. So you're going to start to see some pressure built in. Refiners were asked to commit to consuming all of the crude that they purchased through the local quota system. That is going to be a big problem going forward. And then Indonesia COVID-19 crisis is hitting gasoline demand in Southeast Asia's leading economy, again, echoing a slump that we saw similar to India, and we'll talk about that in segment 3. When we look at floating storage, again, as we've been saying, we expect it to continue to go sideways, but increase a little bit, which is going to put us back around the 5-year average as the 5-year average comes down to meet where we're coming into as we continue to pull in more crude. Imports dipped in PADD 3. As we were saying, we expected to essentially create a chevron pattern, but just trending higher. So we're going to have higher lows and slightly higher highs. And just because we're going to continue to see those imports pick up into PADD 3. PADD 2, as we were saying, we expected it to come down to about the 5-year average, fell a little bit below. Just we're going to have a little bit of a bounce back up as the imports accelerate. And then when we look over the last 29 years, you can see that refinery utilization is kind of flatlined, still below that 29-year average. But we expect to see it, it just won't get to where it normally is at this time of year. And it's just as we continue to come through and with COVID picking up, people adjusting some of their travel plans a little bit. And as we, again, this was our base case, just even though we were told we were crazy, our base case was that you were going to get, again, COVID was going to increase a bit. You were going to get some concerns. You were going to have these issues with wages and savings. And now, here we are. And that's where we think that we're going to get some of the slowdown as we go through the remainder of August. So now in the next segment, we're going to go through refined products in a bit more detail and break them out piece by piece to go through not only storage, but also some of their demand drivers.